Today is May 1, 3:43 p.m. We detected unusual options on Match Group. MTCH is the ticker. This is the company that runs Tinder, and they will have earnings coming up, I believe, on May 2nd after hours. You'll see it hit a yearly low at $33 quite recently, last week. And so these unusual options we're seeing are quite interesting and could be an earnings play. So in this video, we're going to go over these unusual options first, and then look at the direction that these large institutions are putting on, and then suggest the trade, which is quite similar to it, but slightly a little different, just to reduce the buying power, because the capital required to put on the trade that these large investors did was quite large. And so without further ado, let's get right to it, since the market is closing. And so you'll see here these 6,220 contracts here for the May 19th. This was done at 12:52. Okay, so they were selling the 32.5 strike puts and then taking that credit to buy the 42.5 calls. And so if we were to calculate that buying power, one of these contracts to sell that basically means they're willing to own the this match shares, 100 shares, which would require 3,250 to buy 100 shares of them at that strike price of 32.5. That's what it means when you sell a put. It means you're going to buy that. And so that costs 3,250 for 100 shares. So per contract in options, that's that much. And since it's 6,220, that is $20 million, right? 20.2 million. So that's quite a lot of capital to put on this trade. They took this, they used this amount of capital, put it on, and then bought those calls. So you'll see here on May 19, this is their 32. Here they are. You'll see that 6,000 here, much greater than the open interest. And then they sold that, and then they bought the 42.5 strikes here. Also here, volume much greater than the open interest at 4,000. So they bought that. And so you'll see here, this, when we look at the trade, here's the company profile. You'll see here they own Tinder and a couple of other these dating websites here. Okay, so the risk profile on this trade is bullish. It's a synthetic trade. It's basically like owning 100 shares of the stock per contract, because the delta here, well, the delta here is actually less. It's about 38. The reason why is because they picked strike prices a little bit less, but this allows them to have a hedge. So this stock can drop all the way to about 32 at expiration on May 5, and they will break even and not be at a loss. So this has a built-in hedge on this. So it's also negative vega, which is very good for an earnings trade, because volatility will contract, and positive theta is also good. So there's no time decay. So this trade will benefit as the price goes up at its current price of 36.15, and it'll be profitable because it will be above that zero line. And so that that break even is over there. And so what we did instead was we did the same thing with this, except we added an extra what you can do is you add an extra put here. You buy a put over here. We bought it at the 27.5 strikes. And what that does is that once you buy that, you reduce your buying power requirement. Originally, it was at 3,250. Well, by buying this, it's essentially saying you're going to sell this and you're buying that. And because this is a $5 wide spread, that's would require just 500 buying power. And so you can adjust this based on how much buying power you want. You can choose a different strike to buy. If you just want to use 100 buying power, then you pick you buy this one, 31.5. And then that width is only $1, so that's $100 of buying power. And so for our trade here, we created this bull put spread here, collected 76 in credit, and then we bought this 42.5 call and still collected this credit here. And so this is our trade. Let's take off their trade here. And so this is our trade. We also have that same kind of break even here at about 32.2 here. So it also is bullish as well. Just less buying power required to put on this trade. The difference slightly is that we have a slight negative theta decay and a slight positive vega, and that's the kind of the sacrifice you have to make just to be able to put on that trade if you don't want to spend that 3,250 buying power. So since it's so minor, we still went with that trade, and as long as it doesn't drop below 32, and so 32 is, you can see, is below this low here at 33. So if we zoom out some more, match stock has never dropped below 33 for this for the year. So that's why this break even at the 32 mark is a good selection. And so if this goes up or if it goes back down, we have that strong support at the low at $33. And so that is why this trade makes sense to us. So we're thinking at earnings, we should expect something going up. We're not sure how far up. If it does go down, as long we don't think it will go, it will break that 32. If it does break it, the loss is reduced. As you can see from the graph of our analysis, the slope of this purple line is not very steep, and so we can take off that trade before it hits max loss, which is that blue line. So that slope here is not as steep as that blue line, so it's a risk reduction. So if it does break that low for whatever reason, which could happen for earnings, we have time to take off that trade without enduring a large loss on this trade. Okay, so that is our analysis. Please like this video. It helps us make more videos and to share with more people about our knowledge in this unusual option strategy. Please subscribe if you haven't, and hit the bell icon, and you will be notified if you want to see more unusual options as they come. Take care, everybody, and good luck.